Sheila, it is great to see you. So let's start there. President Trump, we know he's zeroed in on this issue of affordability, like this temporary cap on credit card rates. Got a new Bloomberg report. They're citing sources, Sheila, saying that Bank of America and Citi thinking about offering cards with a 10% rate. What do you think, Sheila? Smart idea, smart policy?
Well, I think at 10% is a pretty low rate, but the rates they are now, the average is like 22.5%, is pretty ridiculous. And in point of fact, banks have kept credit card rates even high, even when the Fed was lowering rates to try to stimulate the economy. It wasn't trickling down. So I think there's a lot of room to cut there without having to withdraw credit. A lot of these doom and gloom arguments being made by banks are really based on their own kind of self-serving argument. Well, we're going to pull back, we're going to eliminate 80% of people or whatever from credit cards if we get this interest rate cap. So I think that's not well substantiated. There are studies, a Vanderbilt study that says even at 10%, they could serve the vast majority of their customers. So I think the truth lies somewhere in the middle, like most of these issues, but at least this has put a spotlight on how really high credit card rates are. Certainly historically, they're very high, and the questionable justifications that the banks are providing for keeping them that high.
It is interesting, Sheila. I mean, you're kind of hard pressed to think of many areas where Donald Trump and Senator Elizabeth Warren can find agreement. But
Right.
The good senator is there saying she wants a law passed to get a cap on credit card interest rates. She seems to dismiss these concerns that the big banks have brought up here. It is interesting where these two can find some common ground.
Right. Yeah, well, it's the populist left meeting the populist right. It's probably banking's worst nightmare. I mean, I think you're kind of seeing now that this administration is a mixed bag for banks. So they've gotten a lot of deregulation, a lot of irresponsible deregulation, as far as I'm concerned. But now they're coming after them in different ways, and credit cards really are at the top of the list. It's a pain point for retailers. It's a pain point for consumers. So it's smart politics to go after them. But we've got this debanking lawsuit, crypto. There's a big fight between the banks and the crypto industry over how to regulate crypto, and that's all about relative competitive advantage to banks. The administration is clearly on the crypto industry side. So this is definitely a mixed bag, this administration for banks, and they've got their work cut out for them, I think, on some of these policy issues.
On that point, Trump and the relationship with big banks, the roller coaster there was this other big headline. I'm sure you saw this today. Trump now suing JPMorgan and CEO Jamie Dimon for at least $5 billion. Says the bank stopped offering him and his business's banking services. He was debanked, in other words, allegedly for political reasons. JPMorgan is firing back, saying, listen, the suit has no merit. I mean, obviously, Dimon and Trump have a complicated relationship, goes back many years. What'd you make of that headline, that report, Sheila?
Yeah, I didn't know. I really don't know what the facts are. I thought the timing was curious. It's so long after the alleged charged debanking incident. So I'm not sure what to think about it. Debanking was carried too far with the prior administration. There's no doubt about it. It certainly is appropriate for supervisors to look at banking relationships. And if a bank's dealing with a very high-risk customer from a illicit financing or money laundering standpoint, there's going to be extra scrutiny on those accounts. Politically motivated debanking never should have been allowed. I don't know if it was going on or not. I take at face value that Chase says they don't do that, but we really don't know what the facts are that led to the termination of these accounts. So I think we need more evidence and need to learn more about what happened. But the timing is strange. I thought it was interesting that it would be coming now.
More broadly, Sheila, I'd love just put your old FDIC hat back on and just get your take on where we are, the U.S. banking system, Sheila. I mean, obviously, listen, we heard from the big banks; they reported financial results. I think broadly they were strong, but obviously, just because you're beating on the bottom line, that doesn't tell the whole story. So I'm just curious to get your take, like how healthy. How resilient are we, Sheila?
So I think the big banks at least, will have a very good year this year. They're already having a good year. So they've got deregulation, rates are going down, which on the investment banking side of these large banks, they're doing quite well. Interest rates go down. The lending side is more of a mixed bag, but on the trading side and investment banking side, rates going down leads to deal activity, leads to bond issuance, leads to a lot of inflated asset values. A lot of things. If you're an investment banker, a lot of good things come from lowering interest rates. So I think they're going to have a good year. I mean, longer term, I don't know how stable we are. Mr. Trump is really running this economy hot. We've got credit stimulus, we've got monetary stimulus, we've got fiscal stimulus, we've got tax cuts. It's coming at all sides, and that works until it doesn't. And things are fine now, but things look good prior to the financial crisis in 2008, and it was really just building up to a fairly significant, fall. So with the crash of the stock market, the housing market. So I hope that doesn't happen. Now everybody's worried about tech. Housing's inflated too. So we'll see where all this ends up. But I think, longer term, the risk that these highly inflated asset valuations, especially in the stock market, will correct, and how that impacts banking. Consumer spending is heavily driven now by the wealth effect of inflated stock portfolios. So the higher echelons of wealth are really driving consumer spending now. That's not the way it used to be. It used to be the middle and lower income people. But now it's the higher echelons, and that's being driven by these huge gains they've had in their stock portfolios. So if that comes crashing down, it could have a big hit on consumer spending and then a big hit on the economy. So if I were a banker worried about something right now, that would be it.
Sheila, we're always lucky to have you on the show. Thanks for your time today.